Okay, so what are moving averages? This is the first one that we're going to discuss here, in our list of indicators, because moving averages are probably the most used and the most well understood. Okay, so the moving averages is just the price. What a moving average is, it's just the price in, the average price in a given period. This can measure trend, support, and resistance, and the period size is called a sliding window. All right, so if you see here, this is Facebook. This is during the time frame when Facebook was really mooning. Okay, it was very they're very, very bullish of the stock. And if you notice, with a window size of 100, we follow the asset a lot less closely. Okay, so with a window size of 50, we are a lot closer to the asset. And also notice how when we have little dips, notice how they find support at the moving average, either one or the other. Okay, when we have stronger dips, right, so dips that busted through the support that the 50 period moving average could get, we saw support from the 100. Okay, so when one is busted, the other one will will provide support. Okay, so does that make sense so far? Okay, so the upward slope here is an indication of a bullish trend, and the downward slope, or negative slope, I should say, is bearish. Okay, so that should be pretty obvious to you, right? This thing's going up. That means, if my moving average is going up too, probably a sign that things are in agreement, and that's bullish. Okay, larger window size will account for more data. It's slower to change, so that means it won't be so volatile. Okay, so this could be a good benchmark for long-term support and resistance. Common large window sizes are 50, 100, and 200. Now, this is something that you all should really take note of, because oftentimes in the literature or in the articles, when Forex Live comes out with an article like, oh, the Japanese yen just broke the 100 period or 100-day moving average or something like that. I had an example of an article like that. That is a very bearish sign, right? Because remember, these moving averages are measurements of support and resistance. So if I could break through my support and resistance, that means that I'm seeing, that's a very bearish sign. Okay, and again, here is an example of the 50 versus 100 period moving average. We have notice how with a smaller window size, we are hugging the asset a lot more closely. Okay, so as the asset changes, the 50 period is a lot faster to react to that than the 100 period, because the 100 period has more points to average in. So he's just kind of going to gradually change. Does that make sense? And again, just to repeat that, the moving average size with a larger window size, moving average with a larger window size is going to change a lot slower than the window size, than a smaller window size, smaller respective window size. And that's because with a smaller window size, we just have less points to deal with. Okay, so we're able to follow and track the asset a little bit better. With a small window size, again, that's accounting for less data. It's quick to change, so it's more volatile. This is a good measurement of recent support and resistance. So some common small window sizes are 3, 5, 14, and 22. So common moving averages, we have simple moving average, where all candles are weighted equally. Okay, so when you have a simple moving average, you simply add up all the prices and divide by how many you have. Okay, with an exponential moving average, more recent candles are given more precedence. Okay, so the weighting of the candles in the front of the chart is more so than that of the back. Okay, and so that way we are able to kind of compensate for the fact that moving averages are going to change rather slowly, as the asset evolves. Okay, so if there's a dramatic change in the price of an asset, the moving average isn't going to change until a couple bars down, right? Because it's an average. It's taking into account what's happening over a window size of candles. But the moving average tries to account for that a little bit better, again, by weighting what's happened up in front. So the but the exponential moving average is still just an example of a general case of a weighted moving average. And the emphasis weight, which just means that the emphasis is different on different periods or different points in that sliding window. Okay, so the simple moving average, again, everything is weighted equally. Weighted moving average, we put precedence on various points in that period size, and exponential moving average, a special case, puts emphasis on the more recent candles. So common, again, we're still in the discussion of common moving averages. Let's see, interesting, we just covered that. I don't know why I have that in there twice, sorry. Multiple moving averages. So for two moving averages of different window sizes, if you noticed before, we had the 50 and the 100 that was in every single example. Okay, so what that is an example of is what we call the fast moving average, which is the smaller window size, and the slow moving average, which is the longer window size. Anybody want to take a guess why fast window size and slow window size, why they're called that? Anybody? If I put you guys to sleep that quickly?
So I think on a small scale, there's more volatility, I guess.
Exactly. So on the smaller scale, because we're dealing with a lot less points, that tends to react quicker. Okay, so our moving average is going to react faster than if we have a longer window size where we have more points to average. Okay, so why would I want to use two moving averages? Well, with two moving averages, I can identify certain behaviors, right? So for example, we have a golden cross where the fast moving average crosses above the slow moving average. That is taken to be a bull signal. And the converse, the death cross, as we call it, where the fast moving average crosses below the slow moving average, that we take to be a bear sign. Okay, so here's a great example with Facebook when we finally, this was when they had some troubles in the Senate. It was a huge Senate hearing. We had, this death cross here, signifying that, bearish behavior has taken over. However, when, things were resolved and people realized Facebook wasn't going to go to zero, we had a subsequent rally, and we saw our fast moving average crossover the slow moving average yet again, and this indicated a bull period. Okay, so similarly, we have the same thing happen yet again over here. And here with Micron Technologies, this is kind of an example, just pulling everything together, where we see as the asset is appreciating, we have some supports here at these faster moving average. Then we can then when we break through here, we see some support given by the slow moving average. Okay, notice we don't have any crossovers yet, just because this asset is very strongly trending. Okay, but as we do see some bearish behavior here, we can see it confirmed by this crossover here. Now notice that the cross happens much later, right? So this thing started turning bearish over here, and that's to be expected, because remember, the moving averages are just averages of the values. Okay, so until those moving averages catch up with this price change, they're just not going to register anything. So why would we use them? Well, they're really there as confirmations. Okay, so again, if we're a little bit more in the long-term investing, I could maybe have a confirmation that, if I invested in this stock way back here, it might be time to start taking profits, because we could see, some turnaround. Or maybe if I'm in a trade, let's say instead of this being 50 and 100 period sliding window size, that is at the day level, maybe I'm looking at the 5-minute level, and maybe I'm in a trade that has turned bearish, and this is just going to provide another indication to me to get out of that position. Okay, and again, with all these moving averages, they're really to be taken with a grain of salt, because moving averages occur very frequently during ranging. Okay, successive trade entry and exit can wash you out. Okay, so this is very, very important, because if you guys are into, obviously intraday trading, or if maybe you want to write some algorithms to trade, one of the first, if you want to start playing around with algorithms, right? I don't know if anybody here is interested in writing algorithms, basically bots that trade for you. It's a very interesting field to get into, and I could tell you all sorts of stories about it. But one of the things that you start to learn how to write bots with is simple moving averages, right? Just because it's easy to do. But it's the most unsuccessful strategy. And the reason why is, no matter how much your asset is trending at some given point, and maybe you're playing on some range bound behavior where it's bouncing back and forth, and you have a lot of moving average crossovers you can get in and out of. There's going to be times like this, right, where the asset is kind of trending, but it's not really, it's doing so in such a way that we're seeing a lot of crossovers. Okay, so let's say I took a trade at every single point of these crossovers. Well, you notice a lot of times I'd just be washed out, right? I wouldn't have made anything. Okay, especially like here where there's a bunch of stuff going on. And if I'm in and out of the markets and I'm not making any money, even if I'm breaking even, don't forget we have commissions that we have to pay for. So these tend to be very, very unsuccessful strategies. However, if you're looking more in the long term, it can be a confirmation of a directional change in the markets.